Dear old work platform, it's not you, it's us. Actually, it is you. Endless onboarding? Constant IT bottlenecks? We've had enough. We need a platform that just gets us. And to be honest, we've met someone new. They're called Monday.com, and it was love at first onboarding. Their beautiful dashboards, their customizable workflows got us floating on a digital cloud 9. So no hard feelings, but we're moving on. Monday.com, the first work platform you'll love to use.
When you think about businesses that are selling through the roof, sure, you think about a great product, a cool brand, and brilliant marketing. But an often overlooked secret is actually the businesses behind the business, making selling simple. For millions of businesses, that business is Shopify. Nobody does selling better than Shopify. They're the home of the #1 checkout on the planet and the not-so-secret Shop Pay that boosts conversions up to 50%, meaning way less carts going abandoned and way more sales happening. So if you're into growing your business, your commerce platform better be ready to sell wherever your customers are scrolling or strolling, on the web, in your store, in their feed, and everywhere in between. Businesses that sell more sell on Shopify. Upgrade your business and get the same checkout Allbirds and Skims use. Sign up for your $1 per month trial period at shopify.com/start selling, all lowercase. Go to shopify.com/start selling to upgrade your selling today. Shopify.com/start selling.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to do a quick overview on what took place in the market last week, and we are also going to dive in on the performance of the month of February and how you can utilize the 3 top indexes to let you know if you should be taking action in your portfolio or basically just relax. Last week in the market, we had an incredibly volatile week. The NASDAQ alone dropped 3.5%. This is the biggest drop that we've seen since April of 2024. The Dow Jones this week was a bit of a winner, increasing 0.59%. The S&P 500 decreased 1.39%. The news cycle for the week did include more announcements on company layoffs. We have had a steady influx, I would say, for the last 2 months of company layoffs. We had Southwest Airlines that's cutting 1,700 corporate jobs, which is 15% of their workforce. Chevron announced layoffs as part of a restructuring. The exact number for Chevron is unclear. Starbucks announced laying off 1,100 corporate employees. Meta has continued its quote-unquote year of efficiency layoffs, which has been impacting a lot of teams. However, the number for Meta is still undisclosed. Kohl's also announced that it is restructuring with job cuts. Estee Lauder is cutting jobs, also unclear, due to declining sales. Autodesk is declining 9% of its workforce because of an AI transition. HP is expanding ongoing job cuts of over 2,000 employees. And of course, we have the biggest job cut of all, which is with federal workers. The IRS is laying off over 6,000 employees. We have other agencies that are also moving towards layoffs. So this is also going to affect the market, of course, and affect our GDP, our ability to grow. All of this news together has caused a lot of volatility in the market. Of course, to add to that, we have the tariff news that has caused many fears of increasing inflation. Speaking of inflation, there was a bit of a bright spot last week with PCE data. PCE data is personal consumption expenditures. Now, PCE measured as expected from analysts, coming in at 2.6% for the month of January. The Federal Reserve does review different types of indicators to determine how they are going to take action on the inflation that we are experiencing. PCE, the Personal Consumption Expenditure Index, is, however, their favorite measure of index and the one that they follow the closest, meaning this index is one of the most important ones to the Federal Reserve. That's because personal consumption expenditures is measuring our consumption behaviors, meaning are we keeping up with inflationary prices? Are we still spending at these prices? If so, it's an indicator that we can almost handle the level of inflation. Whereas CPI is the Consumer Price Index, and that is tracking how much the prices of products are actually increasing, and the PPI is the Producer Price Index, which is measuring the increase in the prices that are being produced before they go to a retailer like Target or Walmart. Although overall in the market, we had a very volatile week, and we also, for the most part, had a down market, I do want to highlight that in the last few hours of the market, we saw a rally begin to take place. The market began working very hard to make up its losses for the week, and I would say to make up losses for the month overall. Now, what the catalyst was for this is a little unclear. I do think it was the positive PCE data, and I do think that we would have seen a rally for the most part for a full day on Friday. However, once the news started to circulate on the very disturbing conversation that Trump and J.D. Vance had with Zelensky, we saw the market begin to react negatively. As we saw this negative reaction, I thought for sure there's no turning back. But then hours later, we saw this incredible liftoff on the market where it was working to recover. I do think that had that conversation not taken place, perhaps the market would have worked all day to make up for some of those losses. But that conversation did bring disruption and more uncertainty to the market.
Hi there, it's your vagina speaking. I know sometimes I have a hard time getting there when we get down, but OMG Cream from Wisp is here to help. The instant arousal makes it easier to, It takes 2 minutes to order online, so let's give it a try. OMG. I literally just went to heaven. I'm gonna try that again. Go tell your friends though, get on Wisp. Order OMG Cream online at hellowisp.com. That's hello, WISP.com, and have it delivered for free. Use code OMG for 15% off your first order.
When was the last time you needed to go to a doctor, but you pushed it off? Made the excuse that you can't find your insurance card, or you'd rather spend the time trying a new Pilates class, or getting a manicure, or thought health advice from social media was good enough. I think we've all been there. Booking a doctor appointment can feel just so daunting. But thanks to ZocDoc, there's no reason to delay. They make it so easy to find and book a doctor who's right for you. ZocDoc is a free app and website where you can search and compare high-quality, in-network doctors and click to instantly book your appointment. You can filter for doctors who take your insurance, are located nearby, and are a good fit for any medical need you may have. And with hundreds of verified patient reviews, you can find the type of care and support you're looking for. From good bedside manner to fast wait times to doctors with the best listening skills. Stop putting off those doctor's appointments and go to ZocDoc.com/female to find and instantly book a top-rated doctor today. That's ZocDoc.com/female. ZocDoc.com/female.
Let's go ahead and review the month of February and unpack how we can utilize the top 3 indexes to guide us on taking action in our portfolios. The month of February underperformed, and there's really no surprise here for a couple of reasons. The first is that we are post-election. So post-election tends to be a little weaker, especially as we're adjusting to a new administration. And then just looking at February historically overall, it tends to be the weakest link in the months surrounding it. And so even if the stock market is performing at an excellent rate throughout the first half of the year, February still tends to be the one that underperforms in comparison to its surrounding months. So there's no surprise here when we look at historical patterns in the market. For the month of February, the Dow was down 1.10%. The S&P 500, it didn't perform as bad. It tried to hold on to its gains as much as possible. We are looking at a decline of 0.47%. The NASDAQ, however, that took the brunt of the blow, coming down 2.64%. I want us to take a moment here, double-click into reading the indexes. The Dow, the NASDAQ, and the S&P 500. These are the three indexes that as investors, we want to periodically take a look at. Sometimes it's important for us to not necessarily be so hyper obsessed with our portfolio and what it's doing on a daily basis, weekly basis, monthly basis. You need to do what's right for your own mental health. But having a healthy relationship with looking at the Dow, the S&P, and the NASDAQ can be very beneficial because it can give you a high-level overview of what is taking place in the market. And it can also alert you to potentially having to go look at your portfolio. Let's go ahead and take a look at February's market activity with these three major indexes to just analyze what was happening and determine whether there's any cause for concern. Granted, hindsight is 2020 because we already know from past episodes what was taking place. I'm hoping that looking back really helps to paint the picture. As you continue your investing journey, developing this kind of market awareness is going to become second nature. It's really important for me that you understand how to use these three indexes as signals, helping you decide when to take action or when to stay at ease. The Dow is a marker of investor behavior. When the Dow is up or the Dow is down, it doesn't necessarily mean that overall people are selling out of the market or buying into the market. What it is telling us is that there is a change in investor behavior. In other words, what is most likely happening is that investors are selling out of one sector and going to find opportunities in another sector. The Dow Jones is measured using a price-weighted method. So we had a 1.10% drop in the month of February for the Dow. That tells us that there is a massive transition that is taking place in the Dow Jones. The Dow Jones is measured using a price-weighted method, which is what indicates what investors are doing, how their behavior is changing or not changing. We don't typically get to see really big percentages on the upside or the downside. So when we do have a significantly large percentage for the Dow Jones, that is an indicator that something is happening in the market and it's worth paying attention to. Taking a look at what is taking place with the S&P 500 and the NASDAQ can also be clues as to what is taking place with the Dow. Now let's take a closer look at the S&P 500. When there is a significant increase or decrease in this index, it is a very clear indicator that people are either purchasing or selling out of their positions. And when this type of activity is happening in the S&P 500, investors are holding whatever their position is. Meaning if there was a drop in that index, people are not taking that money and buying back into the stock market. They are either reserving their cash or they are investing into a completely different type of asset. On the flip side, much easier to understand, if there is a significant increase in the S&P 500, people are buying into the stock market. In the month of February, the S&P 500 dropped 0.47%. What does that tell us? Well, we know already that the Dow was down 1.10%, with the S&P 500 only being down 0.47%. Can you see how it's very clear to us that there was a change in investor behavior? It's not that people sold out of the stock market. It's that there was a clear transition. 0.47% loss on the month is a very minimal amount. It basically stayed the same. It wasn't even a percentage point. The market stayed stable. Now let's look at what happened with the NASDAQ. For the month of February, the NASDAQ dropped 2.64%. That is a relatively significant drop when we compare it to the Dow at negative 1.10%, and we compare it to the S&P 500 at 0.47%. The NASDAQ is made up of technology companies. What does that tell us? It's a very easy way to complete this entire story, and it tells us that technology sold off and that there was a movement of investors into another sector. They didn't take their money out of the stock market completely and put it into a different asset class or held it in their savings accounts. They just moved out of technology and purchased in another sector. Are these movements in the stock market something that you should be concerned with? If you own technology stocks in your portfolio, the answer is yes. The drop in the NASDAQ should prompt you to take a close look at what is happening in the technology sector and, of course, the stock market overall. If you don't own technology, then it can also prompt you to just be at ease, unless you are looking for opportunity. Let's say that you aren't invested in technology and you've been waiting for an opportunity to invest. This might be a great time to buy into the technology sector. Now, the NASDAQ dropped 2.6%, but remember that this is an index that is 3,000 technology companies in a basket. When we start to look at how technology companies have been impacted, we are looking at very significant drops on an individual basis. And so this is where we need to double click into what is actually taking place so we can see the true impact, not just an average overview. As you become a seasoned investor, it's going to be very easy for you to just take a glimpse at your stock app, look at these 3 indexes, and identify whether or not action needs to be taken. Definitely lean into using the indexes as a tool for your own portfolio. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
If you work in quality control at a candy factory, you know strict safety regulations come with the job. It's why you partner with Grainger. Grainger helps you find the high-quality and compliant products your business needs to inspect, detect, and help correct issues. And the sweetest part is, everyone gets a product that's as safe to eat as it is delicious. Call 1-800-GRAINGER, click Grainger.com, or just stop by. Grainger, for the ones who get it done.